Hello, everyone, and welcome back to another AP Macro Review session. My name is Matt Romano, and once again, I'm coming to you from Atlanta, Georgia. And today, we are going to talk about Unit 6, Topic 6.1. Did you hear that right? Yeah, Unit 6. We're going into Unit 6 today. Let's talk about that. Unit 6, as you well know by now, is not going to appear on this year's exam. And when I say that, and I say we're doing Unit 6, then you probably ask yourself, then why are we doing this? Well, let's talk about that first. Let's talk about why we're doing this, because there's a very good reason, a couple of very good reasons why we're doing this, why we are devoting some time the next few days to talk about the topics in Unit 6. Number one, and this is in no particular order, you're here, you're watching this video. That tells me you're devoted to this class. You want to do well in this class. You obviously want to do well in the exam, but there's something else there. You want to do well in macroeconomics and understand it. That is enough for me to believe that you're going to take this exam, you're going to do well, you're going to do as well as you can, and hopefully do well enough that when you go off to college, you're going to jump right into that next level, that intermediate macro class. And when you get there, that professor is going to expect that you know the basic principles of macroeconomic theory, which includes international theory, theories on the open economy. And that's really the position that College Board took when they said, we're going to go ahead and do Unit 6 on these reviews. And I agree with that. I think that's an excellent point. I can't tell you how many times, and this was in graduate level courses, I had professors say, you know, what we're doing today, think back to what you did in your principles course. Think back to what you did in your Econ 101. They're going to expect you to know this, whether it's on the exam or not is really irrelevant to that professor. They're going to expect you to know international theory. So that's one reason why. As you go into the next level, the next course in the sequence, you should know international theory because it's part of basic economics. Secondly, and I hope you appreciate this, I know your teachers do, and every teacher believes this, it's not just about an exam, it's about you knowing macroeconomics so you can view the world a different way, maybe a little more clearly. And this is a big part of the world that we live in, the international theory and understanding the open economy. You want to know that. You want to be able to follow international economics. When you see trade deficits in the news, and there's a lot of talk about that, whether it's political or not political, you need to know what that means. And that's exactly what we're going to be talking about today. So that's why we're doing Unit 6. There are bigger reasons why it's very important that we know these topics and understand them. Again, to be an active participant in our world and to understand what's happening around us. And that's what we as teachers, that's what we hope for you. That's why we're in the business, to try to give you some clarity. And frankly, for myself, it's why I enjoy teaching economics so much. It builds upon itself. It builds upon this course continually. That never ends. So that might be more of an explanation than you needed, but I wanted it to be clear as to why Unit 6 is being covered, and that's why. This is good stuff to know. That's why. So what are we doing today? Topic 6.1 is the balance of payments accounts. This is an account for any country that keeps track of those international transactions. And if you've heard of a trade deficit or a balance of trade, this is where it comes from. It's part of the balance of payments. So the objectives are, first of all, to just simply define what are these balance of payments? What's a current account, capital financial account? What is the balance of payments? We're going to talk about the components of each of these accounts and how that affects the overall balance. And then we're going to calculate these different account levels and the balance of payments itself. So you'll see how all this goes together. In doing so, we are applying skill 1.A, describing economic concepts, principles, or models. And we're going to address a few things. Again, what are the balance of payments? What are debits and credits? What does that have to do with anything? These sound like accounting terms. What does that mean in this context? What are trade deficits and surpluses, and how do they fit into the context of the balance of payments? And then finally, as I already said, how is the balance of payments calculated? So we'll do all that within the context of today's lesson. But first, let's warm up by taking a look at where you left off yesterday. The last lesson was 5.7, which covered economic growth and public policy. And the question you were given, it was an old question from 2002. This was obviously 18 years ago. So we adapted it a little bit because, again, I've said this before on here, the AP exam evolves over time, as it should. And wording evolves and how questions are asked evolves. So we adapted it a little bit to make it a little bit more like the more recent ones, but I'm still going to use the original rubric and the wording of that, and I'll explain how that may be different from how things are done now. So what we have is a government replacing the income tax with a national sales tax. It's going to generate the same amount of revenue and we're at full employment. We want to know how the tax is going to change consumption and savings. We're going to show the effects on the loanable funds market so that we can explain the change in real interest rates and investment spending. And then we're going to take that policy and use it to explain a change in long-run economic growth, which is where yesterday's lesson went in the first place. All right, so the first part of it. What's the effect of the change in tax policy on each of the following? So there was an income tax. Now there's simply a consumption tax. What happens here? This is the rubric answer. Now, I point that out because the way this question is worded, you would not have to write this much. It's a good explanation, obviously. It's obviously accurate and very strong explanation, but you wouldn't have to write all this because nowhere up here does it say explain or explain why. You simply have to assert what happened. So the short answer for consumption, A1, consumption will decrease. National savings will increase. Why is that? Well, you can read the answer here yourself. Income turns into savings and consumption. Obviously, that's where savings and consumption comes from. So when we're taxing income, we're taxing both savings and consumption. Change that to just a consumption tax and only consumption is being taxed. That creates greater incentive to save more money. So with the consumption tax, we anticipate, at least in theory, a decrease in the level of consumer spending, offset by an increase in the level of savings. Now, keep that in mind for the next step. We want to show on a correctly labeled graph of the loanable funds market the effects of that change. So we just said that savings is increasing, and that's what we can show on here. And an increase in savings is going to be shown as a rightward shift of the supply of loanable funds because that's what represents savings in an economy. So there's more money in bank reserves, increased supply of loanable funds. How does that affect the real interest rate? You could see it on the graph, obviously. R to R1 indicates that the real interest rate will decrease. Next question, what happens to private domestic investment spending? We know there's an inverse relationship here. So if there's a decrease in the real interest rate, there's going to be an increase in private domestic investment spending. That's all we have to say. It's an assertion. Part C, explain. Now there's that word explain. So we have to verbalize the causal relationships here. Explain how this change in policy will affect long-run economic growth. Well, let's see what the rubric answer is, and we could discuss it a little bit as well. In the long run, economic growth will increase because, remember, when there's explain, you probably want to use the word because the decrease in the interest rate will increase investment, which increases capital stock and boosts productivity. So they're making all those causal relationships right there in our answer. A term that I used a couple days ago in discussing economic growth, I always use it with my class. Think about capital formation and think about where capital formation comes from. It comes from investment spending. So since we are concluding that decreased interest rates will increase investment spending, the increase in investment spending, what are they spending money on? Probably some new physical capital, maybe some technology, could go into some human capital as well. It's going to increase the capital stock. We're going to see some capital formation, and as a result of capital formation, productivity increases, and that leads to long-term economic growth, long-run economic growth, increases in per capita real GDP. That's your question. That's question 2. Okay, we're going to jump right into what you need to know. There's not a lot to review because this is a lot of very new content. The only thing I considered putting there was net exports, but we're going to get a lot of that within the context of the new stuff. So we're going to jump right into what you need to know here as it pertains to the balance of payments. And we're going to start just with some definitional stuff. There's a little bit, it's almost like accounting, like I said. We are accounting for transactions between nations, between economies. And there's some basic terminology we need to know before we get into the actual balance of payments. And the first is, what are debits and what are credits? What does that mean? What we're doing is we're tracing financial capital. Remember what financial capital is. It's basically money. Financial capital that is flowing between between economies, sorry. And we want to know, is the financial capital flowing into the economy? Is it flowing out of the economy? Debit and credit is how we account for that. So let's say we have trade between the US and the UK. Money flowing from the UK into the US would be called a credit to the United States balance of payments. I'm looking at this from a US perspective. We can look at it from the perspective of any country in the world, obviously, and the same rules are going to apply. Because I'm speaking here in Atlanta, Georgia, I'm in the US, and I know many of you are as well. We're going to take a US perspective, but please understand any perspective would work here. So looking at it from the US perspective, that money flowing into the US, we call that a credit. That's money coming into the US. Why would that happen? Well, it could be because the British people are buying goods from the US. It could be because well, it could be for a lot of reasons. They're lending money to people in the US. It could be a lot of different reasons, but money is flowing into the US from the UK. We call that a credit. If money is flowing out of the US into the UK, we call that a debit. Money is leaving. Think of your debit card. Money is leaving a bank account when you use a debit card. So credit, money coming in, debit, money going out. Very, very basic, very definitional, I know, but it's very important, and it's easy to confuse the two. We're going to have to use those terms when we apply things into these transactions in the current account and the capital and financial account of the balance of payments. So let's get into those accounts. What actually makes up the balance of payments accounts? Define it first. The balance of payments is an accounting system that records a country's international transactions for a particular period of time. Consists of the current account, which we'll abbreviate with a CA, and the capital and financial account, which we abbreviate with a CFA. Let's talk about the current account first. The current account, first of all, you're going to hear more about that one. The current account balance is going to be in the news more frequently. Changes in current account balance would be in the news more frequently. So a lot of people are probably more familiar with the current account. Here's why. This is where we record net exports. And again, a reminder of what net exports are. That's exports minus imports. Ultimately, we're talking about the purchase and sale of goods and services between countries. That's the bulk of the current account, is the balance of trade is represented by net exports, but also net income from abroad and net unilateral transfers. Now, those are technical terms for that. What exactly does that mean? Well, let's talk about that in the context of a few examples of current account transactions. As I just said, net exports, that's simply the purchase or sale of goods between countries. Products that are produced, again, from a US perspective, products that are produced domestically within the United States, but purchased, say, by someone in Canada, well, those are exported goods. And if there are goods that are produced in Canada that are purchased by people in America, from the American perspective, those are imported goods. So net exports would be taking those exports and subtracting from them imports. All of those transactions are going to go in the current account. Earning income from assets owned in another country. That's an example. That's a kind of a specific example, but earning income from assets owned in another country. So let's say you own a stock, or you own a bond, or anything else. You own real estate, and that's paying you interest or paying you some form of income. That would be recorded on the current account, or the opposite, obviously. If someone in another country, someone in Canada, owns property in the US and they're earning income off that property, that income is going to be reported on the current account. And then finally, sending or receiving income from another country. That's an example of a transfer. Remember, transfer payments in general. We've talked about this before. I'm sure your teachers have talked about transfer payments. When you think about government transfer payments, even domestically, it's a payment for something without a good or a service being exchanged for it. Well, transfer payments happen internationally as well. And when they do, they are going to be recorded on the current account. A few more notes about the current account itself. We can look at the current account individually as its own entity, and the current account's not always balanced. If debits and credits are even between them on the current account, then it's balanced. We would say there is a balance to the current account, but oftentimes there's either a surplus or a deficit to the current account itself. So the current account can run at a surplus, more money coming in, or it can run at a deficit, more money leaving. Within the current account, we need to be aware that the balance of trade may also run at a surplus or deficit. This is something we hear in the news. This is something we hear in politics. What is the balance between exports and imports? Of course, if the two are equal, then it is balanced trade, but that's, again, unlikely in most countries in the world. If and when exports are greater than imports, if more goods are going out, therefore money coming in, you have a surplus in the balance of trade. And more than likely, the balance of trade is going to dictate the current account balance. It's not guaranteed, but more than likely, because it's such a large proportion of the current account balance. If imports exceed exports, then you have a balance of trade deficit. So when you see in the news talk about the United States trade deficit, it means that in the United States, we're importing more goods than we export. And we're going to come back to that in just a moment, talk about the implications of that on the overall balance of payments, because it does have implications, and we want to discuss that. But before doing that, we need to look at the other side. We need to look at the capital and financial account, CFA. So what's recorded on the capital and financial accounts? Well, financial capital transfers, purchase and sales of assets between countries. So that sounds kind of technical, but what it's really saying is it's transactions which are going to create and include some form of liability. To me, it's a little easier to look at examples. What do we mean by this? So examples of that, a lot of what gets recorded on the capital and financial account would be the purchase or sale of financial assets, varying types of financial assets, stocks, bonds, other interest-bearing assets, which you can go back to Unit 4 and rethink what are those other interest-bearing assets. If those are being purchased, let's say if we're here in the US and they're being purchased from other countries around the world, that transaction is recorded on the capital and financial account. So again, whether it's a stock, it's a bond, any other interest-bearing asset, those are recorded here, capital and financial account. Foreign exchange market transactions. We haven't gotten there yet. We're going to go there very, very soon. In the next few days, we'll talk about the foreign exchange market. If you're in the United States and for whatever reasons we'll discuss later, you decide you need to purchase euros or pounds or yen or ruble or whatever, that transaction would go on the capital and financial account. And of course, the opposite is also true. Anyone outside the US purchasing dollars on the foreign exchange market, that also goes on their capital and financial account. Purchase and sale of real estate. I point this one out because I think it's a very good example to help with something. It's easy to confuse or know where to draw the line between net exports and the purchase of assets in some cases, physical assets in particular. And I had a colleague one time tell me, think of it this way, and this is more or less going to be true for you. If you go to another country and you buy something and you bring it home with you, it's an imported good. But if you buy something and you can't bring it home, like real estate, it's going to go here on the capital and financial account. I can't bring that home with me. A company builds a factory in another country. They can't bring it home with them. The factory stays there. That's going to go on the capital and financial account. That transaction will, for both countries, obviously. So that's why I put that example up here. Foreign direct investment is a version of that. You know the word investment spending, and this is, again, business spending ultimately. The example I just gave, company builds a factory in another country, that's foreign direct investment. It's going to go on the capital and financial account. I'm here in Georgia. If you go down to South Georgia, you go down 85 and you're about to hit Alabama and Troup County, there's a big Kia factory right there in LaGrange, Georgia. When that was built, that was a big deal. It was big news. That was foreign direct investment. You had a company from Korea coming in and they built a factory in the United States, and you had financial capital flowing into the United States as a result. So that would be recorded as a credit to the United States capital and financial account. Of course, that means it was a debit for Korea because the money was leaving. That's an example of a foreign direct investment that would be recorded on the capital and financial account. As a reminder, as we just said, for the current account, it's also true for the capital and financial account. It's not always balanced. You can have a surplus, you can have a deficit. If there's a surplus, there's financial capital inflow. If there's a deficit, there's financial capital outflow, sometimes called capital flight. Those changes in the capital and financial account balance are going to affect the loanable funds market. They're going to affect the supply of loanable funds. Make that connection. Go ahead and make that connection. I'm not going to get into it today because it's going to come up down the road in a later lesson, but that's an important connection you need to make, that those changes in capital flows are going to affect the supply of loanable funds. You probably already know that. Your teacher probably told you that the first day you did the loanable funds market. So think of this as more of a reminder because it's something we're going to use next week. So again, connect the capital account, the capital financial account, to the supply of loanable funds, and that capital flow is a shifter of the supply of loanable funds. All right, so those are the parts. You put those two together and you get the balance of payments accounts. Remember this, I already said it, any transaction that causes money to flow in is a credit, any money that causes money to flow out is a debit. So an important part to this, the sum of all credits has got to match the sum of all debits for the overall balance of payments. Not necessarily within the current account or the capital financial account, but for the overall balance of payments. So for example, if there's an increase in the current account balance, say there's a surplus, then there's got to be a decrease in the capital financial account balance, or vice versa. They both work out that way. That's why it's the balance of payments. These two sides have to balance each other out. That's how it works. And in the end, this identity is going to be true. Write that down and know that the current account plus the capital financial account must equal zero, meaning the balance of the two must equal zero. So if there's a surplus in the current account, there's got to be a deficit in the capital financial. If there's a deficit in the current account, there's got to be a surplus in the capital financial, so that when you add them up, they're going to equal zero. We can take that as fact, but again, you're an AP macro. Let's take the next step and understand why. Why is that? Why must there be these offsetting effects? Well, let's go there. All right, so a little visual here that I had a little trouble wrapping my head around a little bit, but I think it's helpful. Let's assume that this big rectangular cube thing here, it represents our balance of payments. And we have, let's just say the capital financial account is up here in blue and the current account is down here in green. Let's say they're balanced as they always are, but both of these are individually balanced. So right in there, that white line represents essentially zero. There's no surplus or deficit on either one. They are balanced out. So that's where we start here in this example. Now let's assume that in whatever hypothetical country we are in, there's a trade deficit, and that trade deficit leads to a current account deficit, which means the balance is a negative balance. And I'm going to show that visually in just a moment, but I want to walk through what happens to cause the changes that we're going to see. Why must that trade deficit, why must that current account deficit be accompanied by a capital financial account surplus? Well, because we said so, obviously, and the short answer is because of this equation. But let's get into what actually is going on. If there's a trade deficit, we know that means that imports are greater than exports, that a nation is bringing in more goods and then it is selling to other nations. And ultimately, because of the way we calculate GDP, C plus I plus G plus NX, I'm looking at the expenditures approach, of course. What this is really saying is that the citizens of a nation are purchasing more than they're producing. They're purchasing more than national income. And to do this, we have to pay for it somehow. Money has to be borrowed from abroad. And that borrowed money is a separate transaction, which is going to be on the capital and financial account. In other words, a liability is being created with that borrowed money. So the debit to the current account, that trade deficit, money leaving to purchase all those imported goods, is going to be offset by a credit to the capital and financial account. And remember, that white line was zero. The capital financial account is going to move past zero into a surplus, where the green, the current account, is going to move into deficit as a result. They still balance each other out, but you have now a surplus on the capital financial account and a deficit on the current account. That's the reason why. And again, it all comes down to this equation. It comes down to this equation, and it comes down to the term balance of payments. All right, let's practice this a little bit. We're coming to the end here. We want to make sure we can apply those skills that are so important when you're applying macroeconomics. So we're going to do a little bit of practice with this. The first of which is simply identifying how transactions are recorded. I do this a lot with my class. I like to put the categories up on the board, the current account versus the capital financial account, and we want to identify for hypothetical transactions, where would we record these, and are they recorded as debits or credits? So I'm going to put a few of them up right here, and we're going to kind of walk our way through them. I'll pause for a moment for you to think, and if you have a chance to write it down, write down for each transaction, which account would this be recorded under for the US? I'm taking, again, a US perspective here. And is it a debit or a credit to that account? First example. All right. Let's say Brandon, who lives in Los Alamitos, California, is very particular about his bread. He enjoys authentic French bread. He has to get his French bread from this specific Parisian bakery that he knows about. It's really important to him. So he imports this really good French bread from this specific Parisian bakery that he heard about. How is that going to be recorded? That transaction, how is Brandon's very high level taste, his high class taste in bread, how is that recorded on our balance of payments? Look at your categories, give it some thought. What we have here is trade of goods and services. He's importing a finished good from this really important Parisian bakery that he knows of. That's going to go on the current account. If you follow my cursor, that trade of goods and services goes on the current account. Follow the money to determine debit or credit. It's an imported good. The goods are coming in. The money is leaving. So that makes it a debit to the United States current account. So we're all over here on the left. All right. Thank you, Brandon, for that example. Second one, an American bank. So a bank that is located in the United States, operates in the United States, they purchase securities from the Spanish government. So they're buying Spanish securities. We've talked about bonds, securities from the US perspective. Well, other countries obviously do this as well. So let's say this American bank is purchasing securities from the Spanish government. Now they possess Spanish securities. Is this going to go in the current account? Is this going to go in the capital and financial account? Well, securities are a financial asset. Financial assets are going to be over here on the capital and financial account. So this is a capital financial account transaction. This is a purchase of securities. So again, money is leaving the US. So we're in the capital financial account and it's a debit to the capital financial account. So that's our combination here. All right. Well, why did they buy those securities? Because they want to earn interest on those securities. So let's say down the road, obviously, this bank is now earning interest from those bonds that they purchased, those Spanish securities. Where is this going to go? All right. This is an example of earning income, in this case, interest, from an asset that is owned from abroad. So the Spanish bonds were obviously from overseas, but the interest payments, those are income. And that income is going to go on the current account. So here we are on the current account. Money is now flowing into the United States. So this is going to count as a credit to the United States current account. A couple more. A wealthy American celebrity purchased a home in coastal Italy. So a nice big home right on the Mediterranean coast, having all their famous friends over and hanging out on the coast. Where is this going to go? Well, this is real estate. Again, you can't bring it home with you. You can't take that home with you. It's got to stay there in Italy. That means it's going to go on the capital and financial account. The money is leaving. It's leaving the US. So again, we're dealing with a debit. So this is a debit to the capital and financial account. All right. An American college student gets a summer job in Canada, sends the paycheck back home to her family here in the US. So they're working in another country, sending that money right back to the US. How is that going to be recorded? Current account, that's income from abroad. You could say that's a transfer payment, depending on the definition. That is a credit. The money is flowing back into the US. So credit to the current account. A couple more. American company builds a factory in Southeastern Asia. We know this happens a good bit. When that happens, they're building a factory. That's foreign direct investment. That goes on the capital financial account. And again, money is leaving. So we're dealing with a debit to the capital and financial account. Foreign investor purchases US Treasury securities. We've talked about Treasury securities a good bit. If a foreign investor or even a foreign central bank is purchasing these, we're talking again about a financial asset. Financial assets are going to go on the capital and financial account. The money's flowing into the United States, so it's going to be a credit to the capital and financial account. So that's an example of very common way we use the balance of payments. We have to identify which account is going to be affected, which account that transaction is going to be placed on, and is it a debit or a credit? Now, another thing that we have to be able to do is calculate that balance of payments. So here's a purely hypothetical balance of payments. It's not even complete. I didn't want to put too many things on here, but I put enough on here that we can give it some thought. So you've got some current account levels, you've got some capital and financial account levels, and we want to look at this data and make some determinations about balances. Keep in mind, the current account plus the capital financial account must equal 0 when all is said and done, and that's going to affect one of our answers on here. Two questions I want to ask. First, I want us to calculate the current account balance, and then after doing so, calculate net foreign direct investment. That word net means we've already done the subtracting. It's already been credits minus debits. What is the net foreign direct investment that should be placed on that capital and financial account? I'll pause for just a second so you can gather your thoughts and write a few things down. If you're watching this as a recorded version, obviously pause yourself and organize your thoughts. How do you go through this process? Again, the first thing I'm asking is calculate the current account balance, then take that and calculate net foreign direct investment. Okay. To help you through the process, what helps me? Let's identify the items up here and identify, are we talking debits or credits? So we have exports and imports. We have interest payments abroad. We have interest payments received. We have transfers received. We have transfers paid. Exported goods, the goods are going abroad. The money's coming back in. That results in a credit. In this case, $1,000 credit for this particular current account. Imported goods, the goods are coming in. The money is leaving. So you have a $1,200 debit. Interest payments abroad, that means the money's leaving, $1,000 leaving. Interest received from abroad would be a $900 credit, $900 coming in. Transfers received, you have $500 coming in. Transfers paid, $600 going out. So when you add those up, your credits come out to $2,400. You have the $1,000 plus $900 plus $500. Your debits come out to $2,800, $1,200 plus $1,000 plus $600, leaving you with a current account balance of negative $400. So you have a deficit on the current account. Okay, that's going to help me with the capital and financial account. If I know there's a deficit on the current account, what must be true on the capital and financial account? There must be a surplus, and it must be an equal surplus. So we must have a surplus of $400 on the capital and financial account. I need to solve the last part of the problem. What's the net foreign direct investment? Well, what do we have so far? We have the purchase of foreign financial assets recorded. That's $1,700 that's leaving. There's foreign purchase of domestic financial assets. That's $2,000 coming in, leaving us with a $300 surplus. What does that mean for net foreign direct investment? You must have a balance of $100 there, a positive $100 to bring us to that $400 surplus on the capital and financial account. So again, that's just an example of how everything's got to balance out and a way we can approach that to fill in the blanks when something is left out, and again, apply that equation that we learned here today. For a little more practice, I've got a couple multiple choice questions. I'll go through them relatively quickly. But again, this is just additional application of what we have already discussed. So this first question, which of the following would be a current account transaction? This is a very common question in AP Macro. And again, it helps you understand what the current account is versus the capital and financial account. What's recorded on the current account? When you, again, for any multiple choice, any topic, try to answer the question before you look at the options. Now, in this case, you really have to read through them, but you can remind yourself what is covered by the current account. Well, net exports, the sale of goods and services, income from abroad, transfer payments from abroad. What isn't? Well, primarily financial assets or anything that creates a liability. So when you walk through these, it's going to be really clear if you've already thought through what you're looking for. A, India buys $10 billion of new US Treasury bonds. That's a financial asset. Capital and financial account, that can't be it. B, US buys 5% stock of another US firm. So one firm is buying stock at another firm. No, it's not even international, but it's also a financial asset. US firm builds a new factory in Kenya. No, we already talked about that. That's foreign direct investment. That goes capital and financial. D, a United States firm sells $500 million of products to a Chinese company. Oh, well, that sounds pretty good. That sounds like net exports. Check E to make sure. US buys $8 billion worth of euros. No, we said that's a financial asset. That goes on the capital and financial account. Correct answer is going to be D. Let's look at another. Country could have an increased surplus in its balance of trade as a result of, all right, stop for a second again. Reread that and make sure you've read it correctly. It says balance of trade, not balance of payments. You've got to make sure when you're answering one like this, you're clear. I'm dealing with balance of trade, which is net exports. I'm not dealing with the overall balance of payments. That's going to be an important point, and it's an easy one to just read right past and go directly to balance of payments instead. When you do read it correctly, you'll get the answer is B, declining imports, rising exports. That's going to give us a surplus in the balance of trade. More is coming in terms of money, the financial capital, more is coming in, less leaving. All right, similar to the example I just did a few minutes ago, here we have a table. Table gives the values of selected accounts in a nation's balance of payments in millions of dollars. Based on the table, which of the following describes the balance in the current account and in the capital and financial account? So I'm going to look at this, and first I've got to classify again, what am I looking at, and are we dealing with a deficit or a surplus to the current account or the capital and financial account? Well, I've got exports, imports, net income from abroad, and net unilateral transfers. Well, what should stand out, as soon as I look at that, which stand out is those are all current account transactions. So I'm only dealing with the current account here. I work my way through those transactions and I see the balance of trade is a positive 100, but the net income from abroad is a negative 150, brings me down to a deficit of 50. you even add in the net unilateral transfers, you're still at a deficit of 30. We have a current account deficit here. And if you have that information, now you're down to C or D. It's a 50-50 now. As long as I know that the deficit in one account must be offset by a surplus in the other, this becomes a really simple question. The answer is C. And then finally, I just said it, just thought I'd reinforce it one more time. If a country has a deficit in a current account, there will be a what? Well, that at this point should be pretty simple. Surplus in the capital and financial account. Now, where could we mess up on a question like this? I could certainly see B and C being places where we trip up a little bit, maybe go too fast and easily make a mistake there. So yeah, answer is A. Let's debrief. That's pretty much everything. We covered the balance of payments accounts here. We've talked about trade deficits. At this point, you should understand and be able to define the current account, the capital financial account, and the balance of payments, and understand how those work together in one entity, the balance of payments. The components of the capital account, capital and financial account, what those components are and how they affect the overall balance of payments. And then, of course, calculating all three of these. That is applying this model. It's applying that concept to better understand international transactions, how they're recorded, how they're communicated out there in the broader economy. And that's something you can use way beyond AP Macro. It's something you're going to want to use as you view the world and what's going on out there. So that's that for topic 6.1. Going to give you a homework assignment. This is from 2014, question 3. We're only going to do parts A and B because we want to look specifically at those parts that talk about the balance of payments in some way, shape, or form. So go ahead and take a picture of that if you're watching this live. And of course, if you're watching the recorded version, then pause right here and work on this question so we can pick up there next time. And that's all I have for you today. As always, I want to remind you that if you or anyone you know has any concerns about your devices, your internet access, and being able to take the exam, need to contact College Board, and this is where you can do it, cb.org/tech. I want to make sure that you are able to show what you have learned, that you're able to show what you know, and that you're able to get credit for that work. And with that, I want to thank you for watching, and I hope you come back and see us again, and I hope wherever you are well. Have a great day.